Ever wondered how foreign exchange is managed in India? It's all under the aegis of an act known as FEMA, the Foreign Exchange Management Act. Established in the year 1999, FEMA stepped in as a successor to the Foreign Exchange Regulation Act, or FERA, which was enacted in 1973. This change was prompted by evolving economic conditions in India, particularly in the wake of liberalization. The main objective of FEMA is a significant one. It aims to facilitate external trade and payments. But that's not all. It also promotes the orderly development and maintenance of the foreign exchange market in India. FEMA is tasked with overseeing procedures, formalities, and dealings of foreign exchange transactions within the country. It essentially regulates various aspects of these transactions, including acquisition and holding of foreign exchange, payment and settlement of transactions, and export and import of currency. So in essence, FEMA is the backbone of India's foreign exchange transactions. But what exactly does FEMA regulate? Let's delve deeper. Emerging from the shadows of the Foreign Exchange Regulation Act of 1973, FEMA was born in 1999. This change was necessary to address the evolving economic conditions of post-liberalization India. With a primary objective to facilitate external trade and payments, FEMA also promotes the orderly development and maintenance of the foreign exchange market in India. FEMA serves as the rulebook for the procedures, formalities, and dealings of foreign exchange transactions in India. But what does this mean in practical terms? It means that FEMA regulates the acquisition and holding of foreign exchange. Whether you're a business looking to invest abroad or an individual wanting to hold foreign currency, FEMA has a say in it. Moreover, FEMA also oversees the payment and settlement of foreign exchange transactions. This means that whether you're an exporter receiving payments from abroad or an individual sending money overseas, FEMA's rules apply. And let's not forget about the export and import of currency. Whether you're a tourist bringing in foreign currency or a business importing goods and paying in foreign currency, FEMA's rules are there to ensure everything is above board. The Act also encompasses other related activities, ensuring that the foreign exchange market operates smoothly and transparently. But FEMA doesn't work alone. It empowers the Reserve Bank of India, or RBI, to make rules and regulations to carry out the provisions of the Act. This means the RBI has the authority to supervise and control all aspects of foreign exchange in India, from establishing guidelines for foreign exchange transactions to enforcing FEMA's provisions. In essence, FEMA oversees every aspect of foreign exchange in India, with the RBI as the torchbearer. It's like a watchful guardian, ensuring that all foreign exchange activities are conducted legally and transparently, fostering trust in the system and making sure that India's foreign exchange market continues to thrive. So, the next time you're involved in a foreign exchange transaction, remember that FEMA is there, guiding the process and ensuring everything runs smoothly and fairly. It's much more than just a set of rules. It's a framework that helps India's economy to grow and prosper on the global stage. But what happens when rules are broken under FEMA? Well, the Foreign Exchange Management Act takes violations of its provisions very seriously. If you fail to comply with the rules and regulations, you could face a hefty penalty. For instance, if you're found guilty of acquiring, holding, paying, or settling foreign exchange inappropriately, you could be fined up to 3 times the amount involved. If the amount can't be quantified, the fine could be as high as 2,000 rupees. And don't think you can just pay the fine and be done with it. If you continue to violate the provisions even after the fine, you could be slapped with a further penalty of 5,000 rupees for every day the violation continues. In some cases, contravention could even lead to imprisonment. So it's crucial to adhere to FEMA's guidelines to avoid penalties. You might be wondering, who does FEMA apply to? Well, let's delve into that. The Foreign Exchange Management Act, or FEMA, has a wide sweep, covering the entire expanse of India. But it doesn't stop at the country's borders. In fact, FEMA extends its reach to agencies and offices located outside India, provided they are owned or managed by an Indian citizen. This truly global perspective ensures that the Act's objectives and provisions are upheld, regardless of geographical location. Now, let's break down the entities and transactions that fall under FEMA's umbrella. First and foremost, the Act applies to foreign exchange. This can be anything from the conversion of one currency into another to the transfer of money between countries. Next up is foreign security. Any dealings with foreign stocks, bonds, or other types of investment assets are governed by FEMA. Moving on, we have the exportation and importation of commodities and services. Whether a business in India is shipping goods to a foreign country or an Indian company is importing services from abroad, FEMA is there to oversee the process and ensure compliance with its provisions. FEMA also applies to securities as defined under the Public Debt Act of 1994, which includes government bonds and other forms of public debt. Then we have banking, financial, and insurance transactions that involve foreign exchange or securities. These could be anything from international money transfers to insurance policies underwritten in a foreign currency. Furthermore, any overseas company owned by a non-resident Indian or NRI, where the owner holds 60% or more, falls within the purview of FEMA. Lastly, FEMA applies to every citizen of India, whether residing in the country or abroad. This includes non-resident Indians, ensuring that their foreign exchange and securities transactions are governed by the Act. So, anyone dealing with foreign exchange or securities, be it in India or abroad, falls under FEMA's purview. So, whether you're an individual, a business, or a financial institution, if you're dealing with foreign exchange or securities, FEMA is something you need to be aware of. And who are these authorized persons under FEMA, you may ask? Well, they are crucial players in the world of foreign exchange and securities in India. According to Section 2(c) of the Foreign Exchange Management Act, an authorized person can be an authorized dealer, a money changer, an offshore banking unit, or any other person specially authorized under Section 10(1) to deal in foreign exchange and foreign securities. These authorized persons are given their authority by the Reserve Bank of India. They play a pivotal role in the foreign exchange market, facilitating transactions and ensuring the smooth operation of this intricate system. Everything from buying and selling foreign currency to managing foreign securities comes under their purview. They are the ones who make sure that all transactions are in line with the rules and regulations laid out by FEMA. So authorized persons are the key players in the foreign exchange market, operating under the rules and regulations set by FEMA.